Hello, everyone. This is Paul Damon with Family Capital Management. Well, it's that time of the quarter again where we do our market update. I want to talk about what's going on in the financial markets and how that might be impacting your world. So as we look at the end of the second quarter, and now we're in the third quarter, we want to provide you with timely information to help you in your own planning goals and objectives. We do use the charts quite often that are provided by JP Morgan Asset Management. We appreciate a lot of the research and analysis that they provide. As you take a look at the chart here, we want to look at, this is the S&P 500 over a long period of time, about 20 years. And you can see kind of based on the line I just drew that the markets and the S&P measured by the S&P have been in a upward trajectory for the last 20 years, but with some pretty significant downs included in those. And that's the volatility that we've experienced, and it's been frustrating for many of us. We do feel like we're in a period of uptrend here the last 7 or 8 years since 2009. And so that certainly has been a positive for a lot of our clients, and certainly, hopefully, we'll see that continue. The next one chart looks at the S&P 500 in terms of valuations. So when we talk about valuation of the market, the S&P is measured by what's called a PE ratio, which is price to earnings. And what we're looking at in that number is the long-term trend line for the PE ratio is right around 16 times earnings. So the price of a stock trades at roughly 16 times its annual earnings. Right now, where the market is at, we're really up here in about 17 and a half. So in some respects, you'll hear the analysts and the experts say the market is overvalued. And we believe that certainly it's not undervalued, and slightly overvalued would be a fair description, we think, of the market. It certainly isn't crazy high like it was in 2000. In 2007, you'll notice, by the way, right before the market crashed, the market valuations were, at that point, were not even above the long-term trend line, and they dropped dramatically to 2009 with a financial crisis. 2009 they recovered, and then they went back again down when the market declined in the 2010 to 2013 time period. Valuations dropped also. So a lot of volatility. Prices appear to be slightly higher than the long-term trend line, but not something that we're overly concerned about. This next chart looks at the earnings of the S&P 500 companies. And again, what you'll notice here is that certainly the trend line since 2015 has been pretty strong. Well, this is where the trend line is through the second quarter. The forecast for the rest of this year is to have a continued increase in earnings, and then in the first quarter of next year to start to see some decline, or towards the end of next year, start to see some decline in the earnings numbers. So we'll start to see some slowing down of the growth that we've experienced over the last few years. Certainly, the growth has been pretty strong in earnings, and as that changes, we'll probably see stock prices moderate some. Most analysts don't anticipate outsized returns in the S&P 500 or in the broader stock market in general. The long-term forecast for the next 5 to 10 years, most analysts that we pay attention to, listen to, are calling for 3 to 7% in terms of annual growth of the market. So certainly nothing outsized or exciting, but not bad either. So If we could see a 5 to 6%, we'd be pretty happy with that, and hopefully you would also. The next chart looks at it's an interesting chart because it shows in the red numbers down here, this is the annual or intra-year decline in the S&P 500. So at some point during the year, what this chart is showing us is how much the market was down at that point in time. And so you see some pretty big downs here. As I'm illustrating or identifying, 20%, 34%, 33, 34%. So every year since 1980, the market at some point has been down at least somewhat from the beginning of the year to some point during the year. And yet in most years, about 80% or more, the market ends up positive for the year. So this year, by the way, the down in the market was about 3%, and the year to date, the market is up around 8%. So you can see not a big swing this year like some years, but certainly a significant change in valuation from down 3% to up 8% at the end of the second quarter. So what this hopefully illustrates to you is that every year the market has volatility, and every year the market has been down from the beginning of the year to some point in the year, and yet in most years it ends up positive for the year. And by the way, we wouldn't be surprised if we saw a pullback yet this year in the markets, because it has been such a long time that the markets have been moving in a more upward direction. The next chart looks at the stock market as measured by the S&P all the way back to 1900. So going back a long ways and looking at how the markets have performed over that time period. And what you'll see here, the market tends to move in cycles or trends. So the first cycle here was about almost a 25-year period where the market was pretty flat. Then it had the boom, the roaring 20s, they called it, followed by the Great Depression, and then the recovery, and then a real long period of kind of stagnant returns with this really big decline in here, and then a recovery. Then from 1950, after the war, we had a real boom market, which often happens. Then we had stagflation from 73 to in the 70s. And many of you remember that, the Vietnam War and a couple other things were going on. So it was about a 10-year period where there was very little growth. Then we had another long bull market, followed by the last 15 years where it was pretty stagnant. And now we appear to be in a little bit of a breakout. So if you break this all down, I know there's a lot of data here, but the market tends to have these sideways time periods where it moves nowhere for quite a long period of time. And then at some point, the market has some breakouts and the market moves in an upward direction for a fairly long period of time. Now, the question is, are we in one of those periods now, or is this going to kind of slow down and revert back to the kind of the malaise that we've had the last 15 years in the markets? We don't know, obviously. We don't have a crystal ball, but we are fairly optimistic that we could be in for a nice long-term upward trend. Not dramatic growth, but certainly we anticipate or expect a little bit more long-term positive movements in the markets. This next chart shows interest rates, and that's a lot of people's questions right now. What are interest rates going to do? And so right now we're sitting at a Fed rate of a little less than 2, I think 1.75 actually as of today. You can see there's been periods where it's been quite a bit higher, even in the last 20 years, where we had increasing interest rates, Fed raising rates. We had a long period after the market crash where the rates were dropped dramatically, and then we had a very, very low interest rate for a long period of time, the last 7 years. And then now we appear to be on an upward trend. And we anticipate the upward trend to continue for several reasons. One, as the economy continues to recover, we think we'll see more interest rate rises to try to slow down the markets and the economy. We want to avoid inflation and accelerating financial markets. But the second reason, which we think is more significant, is the Federal Reserve is going to be unwinding its balance sheet. Maybe you've heard something about this, but the Federal Reserve has, to stimulate the economy, has been buying a tremendous amount of bonds in the market, basically putting cash into the economy, and that hopefully to stimulate the economy. Over $4 trillion right today sits on the balance sheet of the Federal Reserve, and that has to get unwound. So they've got to get that off their balance sheet. Only way to do that is to take money out of the economy. And when they do that, when they take liquidity out of the markets, that could cause interest rates to rise. So we would not be surprised to see this top scenario here, where rates pretty quickly move to maybe 3% or even more. The Fed is going to watch very carefully what happens, because they don't want rates to go up too high too quickly. And so we'll see how they handle that, but just be aware that rates are going to rise, and so that does present opportunities and challenges, primarily in the bond market. So this chart here shows all the various bond market segments over the last 10 years, and the top performing asset class in bonds all the way to the bottom. And it is pretty interesting when you look at the data here. Year to date, which is this column right here, emerging market debt is the top performing at 10%, and TIPS, which are inflation protected government bonds, are a very modest, less than 1%. A diversified allocation is about 3% year to date, and that's what you see in portfolios is where we're using diversified bond portfolios, which we always do. The rates on those are right around that 3% total return. The next chart looks at all asset classes, and so a diversified portfolio of stocks and bonds. How has that performed over the last year? Over the last year, it's up about 6%, almost 7%. A diversified portfolio. The top performing asset class is EM equity, which is emerging markets. So finally, after many, many years where emerging markets were performing so poorly and nobody wanted to be in emerging markets all these years, finally we had last year a breakout, and then this year it's the top performing asset class. So it's unpredictable. These cycles occur when they occur. It's hard to know when. It's impossible to predict when they're going to occur, but we definitely are seeing a shift away from kind of the higher quality asset classes to a little bit more risk on asset classes like emerging market and international. The best performing asset class this year is international, by the way. So that's an update on the markets. Hopefully this has been helpful. As far as our allocations, we haven't made any significant changes. We still believe in diversification. We still believe in asset allocation. So most of our portfolios are either in the conservative allocation, which is about 30% stock to 70% bond, balance, which is about 50-50 stock and bonds, or growth, which is about 80% stock and 20% bonds. So depending on your risk tolerance, your goals and objectives, you're going to probably be in one of those allocations: conservative, balanced, or growth. And so if you have any questions on where you're at today and how your portfolio is positioned, or are you positioned properly, we certainly would welcome any questions or any conversation that you might have or want to have about your own portfolio in relation to your goals and objectives and in relation to your risk tolerance. So thank you very much for your interest and your time, for being part of this conversation, and God bless.